afternoon. Welcome to today's webinar on insurance, life insurance to be specific. And as the question appears on the screen there, who will take care of your loved ones? My name is Lutakome from Sanlam. Sanlam is a life insurance company, and I'm here to share with you a few ideas about security and taking care of the loved ones. Now, when I talk about security, some of you may think the security, and you're not wrong, because security is broadly what we do. And one of the things that we say is, it is not from you. It's not for you, but it is from you. So it's very important to understand that whenever you give, you get more comfort than receiving. So a lot of the things we talk about in life insurance is not for you as the person who buys it, but it is from you to those you love. And one of the things that we have noticed looking at the numbers in Uganda, we love looking at numbers. 40 million Ugandans, and about 3/4 of those are below 30. And we have a relatively small working population. So what I was able to pick is about 150 in the national budget times the number of Ugandans who are working is what we spend on security and defense. That excludes the amount of money we spend on private security. That is, you work somewhere, you have a security guard at work. You go to the bank charges you money. Part of it is to guard your money and all that. So security is paramount, and Ugandans love security. It's the consciousness that we have about security, that we need to take it from what is visible as a man with a gun to what is invisible as someone without a gun. Someone without a gun in the financial cycle is the insurance company. So the insurance company works alongside other financial instruments like banking to make sure that you have this certainty about the future. One of the things that I love using when explaining life insurance in particular is, consider your life insurance policy as that security guard you've hired to stay awake at night, stay in the cold at night as you have a comfortable sleep at night. And then what gives you the comfort is the fact that you're sleeping comfortably without any interruption at night. And that is priceless. We pay for a peace of mind, and that's what life insurance does for you. And a lot of it we are looking at involves saving and sacrifice. And normally nothing scares or nothing challenges the future of saving like self-control. Self-control is very, very important in the sense that you need to get hold of yourself. It's something that applies in every aspect of our lives. Most of you go to churches or mosques to pray, and they repeatedly talk about self-control, getting hold of your passions. If you don't get hold of your passions in the little things, it will follow you in the big things, and then it will hamper you, or it will hinder you from achieving greatness. Self-control is quite important, and it's one of those things that holds you from having a financial future for yourself and having the security in insurance that you're looking for. So savings is not a problem of the future. The result is there in the future, but it's a problem now. The problem now in the sense that the planning and savings for the future, there's a natural fight now and the future. So planning and savings for the future, there's a natural fight which places extra value on more immediate needs. There's this instant gratification we have. So we normally use a term called present biased preference to describe that. It's quite important that you try to strike a balance, but you have to skew it towards what is the future. Recently we did a study amongst one of our employers, and he has over 800 staff members, and we asked what is that thing that keeps them at night if they were to mention it, and realized that a lot of them are worried about retirement. That is a bit self-centered, which is it's very natural, it's not unnatural. So that time comes when someone is not ready because of self-control, when they were able to do it. So having no life insurance at any one time in your life is one of those constant reminders that you lack self-control as a human being. So I'll repeat that having no life insurance as a person is one of those constant reminders that you have no self-control as a human being, and it's not a very good attribute to have as a person. So one of the major challenges we see there is people are not willing to make sacrifices. I love using the screen there on a person. We have a person now and 30 years to come, or 60 or 40, depending on what time God has given them on earth. And the two are constantly fighting. So making a sacrifice makes one side of the number line sad, another side of the number line happy. And in trying to achieve that, we'll try to look at that animation, where if every time we increase our current expenditure, it makes our future self very sad. And every time we decrease our expenditure and save more, it makes our current selves sad, as you see there. And then it makes our future happy. So it's important that as people we try to balance that and look at ourselves within those years to come. That's one way of living a realistic life. I still repeat that statement. If someone doesn't have self-control, you normally see them by not having a life insurance policy. So it's something that comes up not because people don't know. There's been a lot of sensitization and awareness that has been created. But one of the reasons why people delay to have that is there is always that thing we call procrastination. The general behavior many times, when people listen to discussions like the one we are having right now, is to push it forward. I will do it later. I will do it next year. I will do it next week. I will think about it after paying next term's school fees. I will think about it after paying rent, and so on and so forth. And that comes up even before someone asks for the price. Sometimes they ask for the price and think it is cast on stone and it will not change. And this can be quite challenging. So procrastination can stop you from achieving greatness, because time is one thing that you cannot buy no matter how much money you have. So every time in life insurance you defy a decision to a future date, you're faced with a challenge of paying much higher. So the demonstration that we have is, like we said, the ultimate goal in life is retirement. When you're seated by somewhere with your better half, it doesn't matter how long you've been with them, but you've retired and you're only working for pleasure. You have something you do just to keep fit, not to survive. And retirement being an ultimate goal in life means that you have limited time on earth to work on that. Some of us start our life journey at 25 when we step out of school, and some of those few years we are at home, so our expenses are limited because mommy and daddy still give us shelter, they give us food. And a few people start their life journey here and start dedicating a lot of money towards saving. A lot of people currently acquire their life insurance policies around this age. And as a life insurance person, I know life insurance is very cheap for the young ones, because one of the assumptions we use when we are pricing these products is the older you grow, or the older you get, the closer you move to your grave. So in life insurance, we are in a business of estimating your probability of dying or living within a certain period of time, and it's a no-brainer. A 25-year-old looks to have more years ahead than a 45-year-old. So the chances of taking up a risk on their life or taking out insurance on their lives and them not living within a certain period of time are minimal, as opposed to a 55 or 65 or 45-year-old. So if the ultimate goal is the same, that is retirement is normally at a certain age, you move through employers right now and you can barely see anyone above 60 in the private side. In most of these institutions, a lot of the work we are doing, the people are really young and people are retired at an early age. A lot of our HR manuals in the formal employment sector have cut off the retirement age to about 60. So if that is the ultimate goal, it's whether you start saving at 30, you start saving at 25 like the person who did that, or at 35 or 40, there's only one bull's eye all of you are going to converge to. That is if we are to look at retirement as an example, retirement and pension is one of the things that we do plan for quite a lot, the savings for long term. And because of the power of compound interest, a 25-year-old would retire more comfortably if they started even with a meager salary. Normally, a 25-year-old is not paid as much as a 35-year-old. But the cost at that time of dedicating whatever little it is that they have is very minimal, because every time they spend a year, they get an increment in income. It normally happens because it has to be there as many times it beats inflation. The less the effect of that money, and they were already assessed at a young age, so they are paying much less as a person. What I mean by that is, if a 25-year-old wanted to buy life insurance, simple life insurance policy of say 10 million shillings, and his premium is assessed to be 20,000 per month, a 35-year-old would be paying about 68,000. So the difference there is what I talked about. The older you get, the closer you move to your grave. So the bull's eye is the same. However, we see a 35-year-old paying about 269% more than a 25-year-old in terms of what they put aside to achieve the same level of greatness a 25-year-old is doing. So in terms of assessing, in terms of the risk and savings that we put aside, I'll give an example. If someone is putting aside, like I said, 19,000 or 20,000 a month, and is targeting one age, 60, whatever amount of money accumulates within that period of time, you would need to multiply that by a factor of 2.65 if you started early. If you started 10 years later, just to catch up. And this can be quite challenging because at 35, normally you have a family to bring up, you have obligations, so there is so much you can spare for this kind of venture. And when you start at 40, the factor goes up to 5.56 in terms of all the factors that are looked at, including compound interest, including mortality risk, and all those details that are there. So I'm not saying if you're 39 or 35 or 32, don't start. The message here is you better start where you are, because 2-3 years down the road, it will be more expensive to have that. A lot of people normally who sell goods normally want to tell you that you buy this, we have a promotion going on, it will expire at the end of the month. Life insurance is real. Always try to buy life insurance before your next birthday, because you save money in terms of the mortality risk, because every birthday you celebrate, you jubilate, you're happy. In life insurance, it means that your premium is going up because of that particular factor that we have. So it's quite important for people to understand this. The life journey, we always set out in the life journey with different aspirations. A number of people would start to work at around 24, 25, and within about 3 years they get married. That means getting a commitment in life. Sometimes the marriages work out, sometimes they don't work out. For the purpose of this discussion, we will not go into that detail. We will assume the marriage works out. So starting a family, that's around 28 years. And remember, this 25-year-old who started up with a life insurance, right now, 28, he has started, he's making his wedding, getting married, starting a certain set of responsibilities. Many times married people today are young, so they share expenses. There's income equality, like these days you don't get paid because of your gender. you get paid because of the skills you bring on board. So I will not say that the person who is 25 and getting married is a man. It can be either way. So you start around that time, 3 years down the road at 28, you have a family. Within 7 years, you probably got a child, a new addition to the family. Two became one, and the one they became was so real that 9 months later gets a name in the name of a little junior. Within 7 years, that little one is in primary school. So if you realize that the time between 25 and 7 years and 3 years is actually 10 years. Now, a lot can happen in those 10 years. A lot can happen, one of them being someone having a family, another person not having a family, another person starting a family earlier. However, I wanted to look at this 25-year-old who started out with a simple insurance plan. The child has started primary school. He started out with a simple life insurance plan. He was earning a modest amount of money and opened up a life insurance plan where I was putting aside something for want of a discussion that would be, say, 100,000. And within exactly 10 years, he has accumulated enough money to push this child through primary school. Now, the person who procrastinated, who said, I will do it next year, the other year, by the time they have a child who is in kindergarten, the expenses are fighting with a reality. And opening up a life insurance policy doesn't appear like something that is within reach, because even the premium is higher. You've gained a few extra kilos in terms of the person, so if your body mass index is done on you, terms are not favorable. Whereas a 25-year-old was sporty, it doesn't matter whether right now they are not sporty, they have already done the assessment, so the cover is there. So within a space of 10 years, which flies in no time, this person has gathered enough money to push the child through primary school without ever having to touch his salary again. So that's what we call money working for you. And this kind of thing, I would love to share it with people who are just leaving the university. Sometimes we talk about this life insurance, and it appears for people who have grown up. But our population is very young, and we need to harness the opportunities as young people. So a young person who is 25, 24, 26, whatever the case, you need to listen to the stories of the 35-year-olds who didn't have insurance policies. Where I sit, I see these stories. In the financial institutions, we see a lot of this. The loan uptake goes up every time a new school calendar opens. Reason being, what happened at day one of work. It's quite important. And the thing is, every time you borrow money to pay an obligation, you're actually paying much more, because that money doesn't come freely. So the point goes back to, if you're 25 or 26, you haven't even thought of settling down in marriage, it will come up, and let it not catch up with you unawares. It's important to realize that you have a period between you and 8 or 10 years where one person you're responsible for will be in primary school, and you will have certain bills to pay. And instead of concentrating on depositing on a mortgage to get a house, you're busy borrowing money to pay fees. It can be quite challenging. I'm not saying everyone does that. There are some people who are lucky. I would say luck, or it's not fate, it's luck. They earn above the ordinary. In our life, there are always people who are above average. A lot of people are within average or below average. And when you're below average, you really need this life insurance as early as possible. It's not for the rich, it's for you. So the person who has done the proper financial planning has two options. Obviously, the person who has not thought about it in time will have to apply for salary advance. If he is in formal employment, if he's not in formal employment, that will be another source, either a bank loan through a money lender or a financial institution. If his credit reference bureau number is okay and he's creditworthy and all that. However, the person who has life insurance, that will be the time to start planning for other things, as the insurance takes care of the future of the education of their child. Now it's time to think about other investments. It's time to plan for a new home or put a deposit on a new house, and you concentrate on that as you look forward to another plan that will look at a secondary education. So we love making New Year's resolutions, and New Year's resolutions are quite important. And I would love to call upon, especially the 25-year-olds watching this. The 25-year-olds, you are the people who have power, just like the common saying goes these days. So the constitution is, power lies in the hands of the people, and like I said, close to 3/4 of the population of Uganda is below 25, and you guys are not going to be 25 forever. You're going to be above 25 in the next 10 years. You'll be 35 and you'll have obligations to pay. One of the things you should do when you're celebrating your 25th or 26th birthday is make a resolution to buy a life insurance plan for yourself. It's going to be much cheaper for you. And what I mean by this is, an average 25-year-old will probably be earning a salary where the life insurance cover costs them about 12% of their disposable income in terms of what they are earning. Let's say you're in formal employment, or you're in a private business, and you're 25, you haven't made a breakthrough, you're still trying to make ends meet. And some of you are still staying at home, so you're not paying rent. This is the opportunity to divert what some of the other people are paying in rent for a future of yourself and your family. So by the time someone is, what you're paying as 12%, for the 35-year-olds, it will be about 2%, because they are probably getting much more than you. But it is much less in terms of your obligations, because it might be 2% for 35-year-olds, but they have 1 million obligations to look after. Normally 25, you don't have a lot of obligations. The wedding meetings, you can decide to attend which one, and you don't have to be the one contributing a lot of money, and so many other things. So it's important that you make a resolution, you stand out, and you embrace life insurance as young as you are, because it's not going to get any cheaper with any additional year you add on your life. So a 2% would result into what we look at. The opportunity cost here is, I was looking at an example of someone having a policy that pays about 120,000 per month. That can be about 12% of some disposable income for 25-year-old who has landed a good job after graduating, and they are working for one of these blue chip companies. For some of you it will be much less, for many of you it will be much more than that, but it's important. I was just looking at that example, and you don't know what the power of compound interest can do to that money within a space of just 10 years, which 10 years is not very far away. Because if you ask a lot of your colleagues who are 35, 10 years looks like the other day. For some of us who have been around for longer, we remember like we watched the World Cup in 2002 the other day. But someone has to remind you there has been a couple of more World Cups between that and now, and you can't talk about any of the players who participated there. Most of them are veterans now, even in coaching. So the opportunity cost is that. The opportunity cost is foregoing a little amount of money. Just to put it in perspective, 120,000 a month is an equivalence of about 30,000 a weekend, in a week, which is on average how much money someone spends on a weekend if he's not the one buying the rounds. If you're buying the rounds, it will be much more. I'm not saying don't have a fun weekend, but if you're having 4 in a month, you can reduce them to 2. It doesn't matter what your age is. If some of you are working in some places in Kampala, just having a meal per day, you can spend 120 in a week or less in terms of that. And sometimes you can forego a meal and you're still alive. In fact, in many cases. Or you can pack your lunch and you're still alive, just to make sure that you have some bit of security or a great deal of security in the near future. So, ladies and gentlemen, it's quite important to embrace this. The future is not going to take care of itself, no matter how much we would love to think so. And the wind is not going to blow you where it wills if you did the proper planning. You need to be the person who stands out, not who settles in. So you need to stand out of the crowd and start the planning for this. And financial institutions exist for different reasons. And the most important thing is the security. The bank will give you an account, you open an account, you save money largely for emergencies, and insurance will look at those long-term obligations. One of the obligations doesn't mean contributing to a funeral of a loved one. It's quite important to do that. But just look for a minute. If you think for a minute that if you did contribute on every funeral, you want it to go on. I'm not saying you become selfish, but it shouldn't be the priority. The obligation is going to be that one thing that you're not going to run away from. One of the scenarios I've ever witnessed is someone wanted to call people to take their child for medication to the hospital. The child was convulsing, sick. They didn't have money. They had been out of a job for a couple of months. They called upon neighbors and no one of them responded. So to get money from them, they had to announce the child dead. And all of a sudden, people were identifying with them, gave them money. Luckily, they rushed the child to hospital. The culture of those people was that they respond when you've lost someone, not when someone is still alive. So the obligation of that still lies on you. You need to take care of them. No one is going to take care of those that you love, just like the initial topic was saying. As the topic of the discussion here is who take care of your loved ones. There's no one who is going to take care of them. It's going to be you. But you can get a partner to do that for you. So I would love to call upon you to use DFCU. You can access all these life insurance options from DFCU Bank. Just talk to your relationship manager, just walk into a branch and talk to anyone there about how you can plan for the future, how you can take care of your loved ones. There is no one who is going to do it for you. You're going to do it. What we are going to provide as the financial institutions, as DFCU, as Sanlam, we are going to provide a mechanism for you to achieve that. But you're going to be the constant factor in this. So thank you so much for listening, for watching and participating. We have a couple of comments coming in on social media that we'll be able to look at. And I think the first one came in from Joanne now N. Mugarura. The question is, what could be the total premium for a family of 4? That is parents and children under 6. That would depend on what kind of insurance you're taking out. I can imagine if it's life insurance, it would depend on what your expectation is. It could be like buying a car. If say what's the cost of a car that takes a family of 4? It depends on what kind of car you're looking at, because a pickup can take 4 people and a Corsa can take 4 people. So it depends on that, but a family of 4 in terms of life insurance can have a plan for as low as 100,000 a month that will try to shield any financial obligations they have, and depending on how the affordability is on their side, what their obligations are, in order to ensure that they keep up with because life insurance should not strain your regular expenses. You need to plan it alongside your expenses so that the policy does not miss a premium just because you didn't plan your cash flows. If it is medical insurance for a family of 4 can also be provided depending on a limit. Medical insurance doesn't cost a lot of money. Each person can be charged about 600,000 to 1 million, depending on which insurance cover you're going with or which company is giving you that particular option. But you can still talk to your DFCU banker to give you these options. They normally depends on what your priorities are. Some people still, they have a family of 4, they are still planning to have children, so they need maternity cover. Some people do not require dental cover because they are very careful with their teeth. So all these are put into perspective when the premium is being determined. So what's important is to look out for a plan that best suits your need. Question 2 is from Nafuja Jacqueline. How does your life insurance policy operate in case of death? Life insurance policy in case of death, how it operates is it provides money to the family. That is what every life insurance cover does. However, there are lots of options that can be done at the time of death. The first one is someone took out life insurance, they have a child has to study, because we have an obligation to educate our children. So what life insurance normally does when someone loses a life is it provides money, first of all, to give that person a decent burial through a funeral where you don't have to call people to chip in, but someone bought life insurance. The other benefit it provides at the time of death, it provides a lump sum amount of money immediately to push the family through the immediate needs, because you can no longer provide for them. It doesn't matter whether you're in business or you're in employment. The reason why this paycheck was coming in on the 24th or 30th was because you were physically there. Now you're not there, the paycheck is normal. So life insurance provides that cash. Then if you had an obligation to save for a long term, let's say you had an obligation to save for 10 years, you've died in the first year, and you had an obligation to save, say, 50,000 or 100,000 or 500,000 a month, life insurance gives that guarantee that that money is going to actually be saved for the remainder of a period, because it had to meet a certain need. So that is a very important aspect of life insurance. You make a commitment, you partner with a life insurance cover, it pushes your family through the short-term hurdles, and you had a target to save a certain amount of money to ensure that your child gets a dream university education. The money will be saved every month up to the period, the end point that you had suggested or you had committed to, and that money is made available to give your child that dream education that you had desired for them. And it's quite important, because sometimes you can choose to save this money with a couple of other people, but because there is no documentation, it becomes very hard for your children to access this money. However, when you partner with a financial institution, you have this level of security, because the financial institutions are regulated and they look out for your interests. And this money will be availed to ensure that the purpose you wanted to achieve is addressed. We have some more questions. Question 3 came from Dion Sekiranda. Is the client at will to withdraw their contribution in case they change their mind at a later date? Yes, Dion. The answer to that is a very big yes. Someone opens up a plan. For some reason, they have lost their ability to earn income and they want to get their money back. That is done and it's provided for. You just come talk to your insurance company or talk to your bank partner and that will be processed. However, that depends on what kind of insurance you bought. If you bought an insurance plan that has a maturity value, that maturity value is subject to a certain period to acquire a surrender value, that's when that happens. I don't want to be confusing you. You bought a policy that has a maturity value, meaning that if you don't die at the end of a certain period, it pays out an amount of money. Those are the policies which will give you money back. However, if you bought an insurance cover to take care of a risk that you're scared of in a certain period of time, let's say you took out health insurance, and health insurance says you're going to pay a monthly premium of 100,000 and will give you treatment up to 10 million a year. And for somewhere you fail to pay money, you lose your income in the 5th month and you want to cancel the cover, that would not qualify you to a refund, because that's a risk on the cover. It doesn't provide money at the end. It provides money every time you fall sick. Or if it's a life insurance plan that only pays out should you die in a certain period of time. Let's say you've just gotten this employment in a mining company and you're afraid that you might lose your life, but the pay is quite tempting. and you say, I have a 3-year contract, I need life insurance because if I died, I might be earning money now, but if I died within these 3 years, I want my family to be given 100 million, 200 million. The policies like that are there, where there is no maturity value, there is no amount at the end, then there is no refund. So that's what I was referring to. So it's quite important to understand your policy, talk to your advisor to look out for your interest. It's the interest that should be able to guide the design of the policy that you take out. Oh, more questions coming in. We have question number 4 from Tasiana. Tasiana Tia Grace. Thanks for the topic. Here are my questions. Tasiana has quite a number. So question number 1, my employer provides life insurance. Why should I buy more? That's a fantastic question, Tasiana. Your employer provides life insurance. Why should you buy more? When your employer provides life insurance, it's a bonus. A question like that can be related to a question like, my employer gives me a house. Why should I build mine? So it's quite important to understand what, when an employer gives you a benefit, a car, a house, life insurance, and all these others, it's a bonus to what you already have. And one of the things that happens, I've seen that happening, where someone gets into employment and they are 25. The employer provides them life insurance every year. And it's budgeted for, and it happens, and then when they are 35, they change employment, because some of these employers are projects. That project is done, and then the next available employer does not provide life insurance, which means that Tasiana has to run and buy her own life insurance. Now, the person who started taking out another private life insurance at 25 paid a much less price than she's doing at 35. She's paying 265% more than the person who started at her previous age when she had just started. So when you try to buy a house at 55, you may not catch up with the person who started building a house at 28. That's the same thing life insurance does. So it's important to understand that what your employer provides is a bonus. It's not permanent. And then it's not comprehensive in many cases, because employers provide what we call term life assurance. So many of our needs require a combination of things. It requires a combination of term life assurance is a cover for a period of time that only pays out on death. And a lot of people, yes, they are afraid of death, which is quite important, but a lot of other people would want some cover that does not only cover death, but provides a benefit after a period of time. And sometimes employers don't provide that, in fact, in most cases. So it's important to take out your private one to cover that gap when you don't have it. Then your employer also comes in handy. Does term or permanent life insurance make more sense for me? That would depend on your circumstances. So term assurance and permanent life, more or less the same thing, means that you buy insurance cover for a period of time when you feel you have a certain exposure, that after which you won't have that exposure. I'll give an example. Someone has dependents. The dependents, the first option that comes to mind on dependents are children. And the children, what happens with children is you're afraid that your child has to go through school, and should you lose your life, the child will not continue with that education. So what this means is, for a period that your child is a dependent, which you can estimate, let's say your child is 16, and by 25 they will be independent. So that's a period of 9 years. You take out a term life assurance for 9 years, that should you die, money is provided to push the child through education. That's that kind of term insurance. Another person who doesn't have a child, that may not make sense. Or another person whose children have finished college, that may not be applicable. So it depends on your life circumstances and what your fears in life are to take out any of those covers. So question number 3, will my survivors receive social security benefits? Social security benefits. Life insurance is not a category of social security benefits. Social security benefits would mean things like the savings that are mandatory through the National Security Fund and other things like the National Health Insurance Scheme, which is not currently operational in Uganda. The National Security Fund is only for employers who have a minimum of 5 employees, and it's not everyone benefits from that if you didn't subscribe or if your employer wasn't compliant. So it's only available in that particular mandatory kind of style. So what we provide under life insurance is normally not mandated, it's optional. Become disabled, yes, it's one of the benefits that life insurance provides. You're disabled, meaning you're not able to perform your duties to earn an income given your experience, training and ability. You have this insurance coming in handy. And will my premiums increase? It depends on what cover you choose. Most covers don't increase premium, but sometimes people are very sophisticated. They want their premiums to increase because the benefit limit they take out might be outdone by inflation. Someone buys cover of 100 million or 10 million and forecasts that 10 million may not be the value they want after 10 years. So they want to have an inflation protector in their cover that keeps the money up to date. So that can affect your premium. But for a big chunk of policies, your premium doesn't change. It stays the same throughout the period of time. So you just have to get in early so that you get a favorable rate. Do I need to get a medical examination? In most of the insurance policies we have on the Ugandan market, we don't subject them to medical examination. It's only a few people who could be subjected to a medical examination if the cover is quite high. And by high, I mean someone wanting cover of 200 million and above. You might be called to do a few medical tests to assess your degree of insurability. So it's, for most of the people, this is normally not given, and because there has been a lot of advancement in life insurance underwriting. So the insurance companies have built capacity to take you on without doing a medical exam. All you do is a declaration of good health, which is done on the application form for the member applying. Question number 5, that is from Don Atungisa. In the event that I have a life insurance policy with an insurance company X, after how long does my next of kin or family get my insurance privilege when I die? Oh, so this one is normally, a lot of insurance companies, especially in the life category, normally pay these claims quite fast. All you have to do is you have to give them evidence that this has happened. Now it won't be you. It is not for you, it's from you. So as long as that evidence is given to the insurance company, the proof of death in Uganda is a death certificate or a medical report, medical certificate for the cause of death. The moment that is done, the average period that companies that have been with is about 48 hours, and the money is transferred to your account or to the account of the nominated beneficiary. So within about 48 hours, that payment is made out and it serves the intended purpose. Oh, Suna Ronald, question number 6. So Suna Ronald has a question number 6. He says, how much is my registration? That will depend on the age and level of cover that you require. We talked about it in the first question. So what your age is determines a lot of that, and then your health status can also determine, depending on the level of cover you're taking. And then the other thing that is quite important is what level of cover you're taking. And how much do I save in my life? Do I save on my life insurance account? Will depend on how much you earn. But I normally don't advise that someone puts aside more than 25% of what they are earning after deductions, the statutory deduction. This is aimed at ensuring that a person is not strained financially. Any mid-term shock that was not planned should not be responded to by cancelling your insurance cover. It's very costly cancelling your insurance cover. Then which medical health centers do I access? Am I limited? That I imagine is relating to health insurance. Health insurance provides you with a list of medical insurance providers, and a lot of these companies have these clearly spelled out even on their websites. So it's they normally put signs on the health centers. The health centers that operate in an insurance environment have signs of which insurance cards that they accept. So there are quite a number. A lot of, obviously we only deal with licensed or legally equipped, legally established entities with the necessary equipment to ensure that they offer adequate services, and then the personnel. Then can my family members access medical treatment through my insurance account? For medical insurance, they will only access if you enrolled them and they got their own accounts opened. So if there's an insurance card given to each of the members, it will be used to, it will only be used by that particular person who needs it. Can I request for my money just in case I want to leave, close my account? We've already answered that. Yes, you can request for your money and get it, but depends on the type of cover you bought. Question number 7, that is Sandra Teza. Is there any life insurance that caters for my entire family but works as an investment? Where can I get some of that? Where can I get that from? That's quite important. Those covers exist. The life insurance plans like that are there. It can take care of your entire family, and it will largely depend on your budget and the life circumstances and what your aspirations are in terms of savings. Yes, so it's savings and investments sometimes they are used interchangeably. When a person opens up a life insurance cover, what they are actually doing is they are saving money, and the life insurance company uses an investment manager to manage the investment for them. So I encourage you to send in more questions. The discussion continues with the discussion will continue even after here. So I've seen a couple of questions here. It's thanks. So it's very informative. Thanks a lot for watching and following. It's quite encouraging that someone follows this. So the other one is Lillian K. Can I terminate my policy that I feel isn't good for me? Do I get my money back? This is a very important question, and I don't know whether this is what Lillian meant, but actually what happens is when you sign up for an insurance policy and you realize in the first 1 month that what you signed out for is not what you intended to sign out for, you have a right, legally protected, to go and change that cover and get all your money back. However, if your tests change later on in that day, it means that, let's say you've been with an insurance cover for 5 years or 3 years and it was meant to go for 10, and you realize along the way that it is not what you actually wanted to have, you can still change your mind, and depending on what type of policy it is, if it's an endowment policy, it will not be able to, it will be able to provide your money back as per the terms of the contract. If it is not, and if it's not an endowment policy, it means you stop paying, subscribing in future, but then you stop the deductions. You stop, that policy normally doesn't entitle you to any refund in terms of that. So some more, oh Lillian, you're watching, that's fantastic. So very informative, Julio Jaimez, when and how can I claim? You can only claim when the event insured against happens, and that can be death, disability, or the policy has reached its maturity. Boaz Tuyasingura, eager to know on how life insurance process, on how the life insurance process, how to go through the life insurance process and achieve this. That's that can be another discussion that we can have in the sense of the detail. The process normally depends on what the parameters of cover are in terms of insurance, and the parameters of cover can be in the sense that someone has an insurance claim for disability. The process normally is not the same as someone who has an insurance cover for, say, critical illness, or someone has a cover for death. That the proof for death is a death certificate, whereas the proof for disability is a medical report showing that this person is disabled. So that's what we pick upon to ensure that we assess the degree of disability and pay the member. So you've been a very good audience for us, and you've been a very good audience for us. And as in my parting shots, as I conclude, I would love to use the words that were said in an environment when one of the fathers of Africa, that's the former president of Zimbabwe, Robert Mugabe, had a press conference. So I think it was last year when there was a press conference, and the president of Zimbabwe had to make a speech to resign, and he actually didn't resign as per the speech. So he made a speech, a very long speech, and everyone was eager to wait for the words of him saying, "I've resigned." He actually never said them, and said the words that people in Tanzania and Kenya would understand very well: "Asante sana." So he made his entire speech. It wasn't about resigning, and then said "Asante sana," and everyone in Zimbabwe was puzzled, saying, "We expected this man to resign. He hasn't resigned. He has just started speaking Swahili." So I'm not going to be like that. I would like to thank you. The discussion continues after here. I will be able to answer any questions that you put on. And please don't hesitate contacting us at the DFCU branches. We will be able to serve you. I would like to repeat again the words "Asante sana." Thank you.